Global capital markets are always evolving, and today both public and private markets play a vital role in our economy. In recent years, it's been said that the line between public and private markets is beginning to blur. Between traditional IPOs, SPACs, and direct listings, there's more than one way for a private company to exit. Today, we'll look at the pre-IPO market, which is generally defined as a private fundraising round of $100 million or more. As an example, the high-profile SpaceX raised more than $1 billion in the first half of 2021 alone and has left its investors hanging on edge for a possible IPO. But what might the benefits be of staying private for longer? And what's involved behind the scenes of investing in a company ahead of a potential public offering? My name is Anu Rajakumar, and today I'm joined by Mark Regenbaum, Portfolio Manager of Long, Short, and U.S. Equity Strategies, and Gabe Cahill, Portfolio Manager for Pre-IPO Strategies, to provide their views on how these creative investment strategies in the gray area of investing can operate. Gentlemen, thank you very much for joining me today.
Great to be here.
Thanks for having us.
So to start us off, I think it'll be helpful to share an overview of the ways that late-stage private companies can go public today. What are the main paths for getting to an IPO, and what are the characteristics of each of those methods that investors might want to keep in mind?
Great. I'll kick it off, Anu. First, I think this is a really exciting and dynamic market opportunity. And it really starts with the fact that many companies are remaining private for longer periods of time. Just if you look over the last decade alone, there has been a nearly threefold increase of the average age of a company upon IPO. But at the same time, these companies are still seeking growth capital, and they are still seeking more long-term holders ahead of an IPO. They want shareholders that can partner with management teams to best position themselves in the eyes of public shareholders. So if you look at 2020 alone, nearly 3/4 of companies that filed for an IPO had previously raised a crossover fundraising round. And this overall activity has really accelerated in recent years. In fact, by 2020, the number of deals had a total value of approximately $60 billion, which was more than a 6 times increase of number of deals and a 30-fold increase in the total deal value versus the prior decade.
Yes, and to add to that, I think that, strategically, it's important for those management teams. As they approach an IPO, they're, to Mark's point, looking for those partners that will be with them for the subsequent decade. And as their VCs and growth equity funds slowly look to move on or their funds start to mature, it's that next set of public investors that serve as their partners into the distant future. And there's been a number of interesting developments on the IPO side, just in terms of the methods that they go public, whether it's a traditional IPO that we're all accustomed to, but SPACs really certainly hit the scene over the course of the last 18 months. Direct listings have evolved over time in a manner that's much more company friendly for the right companies. And we've also seen some other hybrid versions of both. But when you think about the traditional IPO, it's really well suited for a lot of companies that are able to achieve what they need to go public, whether it's a good amount of scale, the right trajectory of growth, or be able to captivate the attention of institutional investors that would like to participate in that transaction. The SPAC has certainly provided an alternative means to go public. It oftentimes provides more capital to businesses than a traditional IPO, involves a sponsor that can provide a layer of expertise, and then also helps transition the company into the public markets, albeit a slightly different route. And the direct listing is reserved for essentially the select few, those that have grown their business to such a place where, it is essentially a name brand name. It has notoriety. It has the public's attention and the attention of institutional investors, such that there isn't a formal offering per se. They just list directly, and it creates a little bit more of a democratic version of an IPO, such that really anybody can participate in that transaction. There isn't really an allocation procedure, which for some companies is a really unique and interesting opportunity to choose.
I think Warby Parker did a direct listing pretty recently. That was one of the most notorious ones I've seen anyway.
Exactly. And I'd echo Gabe's sentiments, which is I think you can almost summarize all of it with regard to IPO paths is that not one size fits all, right? Different companies will be looking for different partners, different solutions, serving different stakeholders. So each has its advantages and disadvantages, but again, it's incumbent upon the company itself to work through the various options to see their ultimate path. an optimal path going forward.
Yeah, on that point, not one size fits all. Let's transition to your role as portfolio managers. How do you both go about identifying private companies that you think might be planning to go public in the intermediate future? And are there sectors that you find particularly attractive right now in this space? Maybe Gabe, starting with you.
Sure. So we have the pleasure and the benefit of meeting a lot of different companies in a lot of different spaces with a lot of very unique business models and technologies. What we generally tend to look for are companies that are benefiting from a secular theme, oftentimes have a disruptive technology that is helping drive that secular change. And that secular theme is something that we can generally underwrite, as is the company's ability to not only continue to generate revenues, but grow those revenues well into the distant future. Those companies are the ones that we find most interesting, at least from an investment perspective, and often look to partner. And when we do partner, it's a phenomenal opportunity to try to help that management team in business. The resources of a firm like ours extend into many different aspects of many different either sectors, industries, verticals, et cetera, or even in financing. And so we try to bring the firm in a holistic approach to the partnership, and specifically with those companies and sectors that are resonating, at least according to our investment thesis, which oftentimes when people think of technology, you got to think of your software names, your different hardware names. You can move into different subtypes of software as a service, but it also permeates other areas. Cloud storage has really dramatically improved the ability for companies to scale in a way that they haven't been able to do before. And that's led us to a number of, I'd almost call them tech-infused genomics companies that are on the cutting edge of personalized medicine. So it really varies, but those are some of the key themes that often resonate with us.
And maybe, Gabe, just a follow-up question there. At what stage of maturity do you typically begin a dialogue with a company? What sort of series are they in their maturity, or if you can quantify when you might begin a relationship?
Sure. When we begin a relationship is completely independent to when we might invest. So we might be helping a company from a relatively early stage, and they know it's too early for us to invest, but we stay engaged with the company, the business, and the management team, and oftentimes are board to help them along the way whenever we can be helpful. When they do get to that scale, when they're generating revenues of north of, generally speaking, 50 million, there are exceptions where they might be a little bit lower, and certainly there are exceptions where we're north of 200 million. At that particular point in time, that's when the fund would look to get engaged and ultimately make an investment and grow the partnership into a financial relationship as well.
And Mark, same question to you.
Yeah, I think this is called disruptive forces in investing. And I think it's fair to say we love to invest in disruptive companies that have competitive edges. And these are some of the most exciting companies out there. They are changing the game in various industries. Some are consumer facing, some are business oriented. Many, like Gabe said, have technological leads or brands that resonate with the consumer, scalable platforms, and just nimble business models for changing economic backdrops. For us, though, it is more about the companies than the sectors themselves. So common attributes, when you drill down, may include the secular growth dynamics. We love market share gainers and, of course, terrific management teams that know how to allocate capital appropriately to make sure that they are really sustaining that business moat over time and having sustainable cash flows. So it's a really exciting time when we think about it all. If you boiled it down from a company perspective, we love to call them beyond privileged and resilient because they characterize many of those elements that we just described before.
Great. Thanks so much for that. I'd love to hear a little bit more about how you typically engage with a company, what that relationship looks like, and any anecdotes that you could share. Maybe Mark, starting with you.
Yeah, when you think about this, there's a very large difference between being just a capital provider and a partner. There's no shortage of capital out there for companies, but what we would debate is the value add that comes along with that particular investment. And so what I think you're hearing myself and Gabe discuss is that we have this buy-to-own mindset. It's an ability to tap into robust global resources of our firm, right? When we talk about crossover investing, that can really help our companies with elements such as data science, ESG capabilities, and a broader network of industry relationships. Management teams want to embrace those investors that can provide the tangible credibility, being viewed favorably by the market as a future public company. So we love to help a company during its journey to the public markets. We love talking about what we call our 4 key pillars. Those 4 key pillars revolve around making great companies, great stocks, and they really focus in on financial communication, capital allocation, corporate governance, and helping the company manage the overall incentive scheme for their employees. We've done this with a bunch of our different investments to date, and this includes helping with C-suite relationships in some of our business services companies. It's been helping to craft public market narratives with some of our consumer-facing investments, and even engaging on capital structure or ESG topics across the entire platform.
Terrific. Gabe, any examples you can share?
Sure. I mean, it's very common for us to meet and engage with companies, as I referenced earlier, independent of a financing round, really to get to know them, understand their business. It's very common for us to go out and visit a company's headquarters and spend a good amount of time with them. When they're private, when there isn't an opportunity to necessarily get involved as an investor in the business, but it helps us build that rapport, help open doors, and I'll get into that in a little bit, and hopefully be there at the right time when they do and ultimately look for a financial investor. So, one comes to mind right off the bat. It's a company we had known for, goodness gracious, 18 months before their first ever private round. We had been out to visit their facilities in Arizona. We had met with the founder on multiple occasions. We had met with their chief scientific officer on multiple occasions to not only understand the business, but understand how it was going to grow, understand how we could be helpful, et cetera. When it came time for them to raise their first round, we were their first call. They wanted to understand how a public market thought about that private round in relation to the IPO, the valuations for each, and what that progression would look like, as well as what they needed to accomplish with the capital they were about to raise to best position their IPO. And we ultimately did make that investment in the middle of the pandemic. So we were in a position to be supportive where it was very difficult for others to be supportive. It was great to be there for them then because it certainly helped pay dividends. It enabled them to finish some of the facilities that we believe will bring one of the most exciting advancements in personalized medicine to market early next year. But it continued to progress. The company's fundamentals continued to improve. And, we utilized some of the resources of the firm. Like we could work with our healthcare team in research, for example, to introduce them to some large publicly traded prospective clients that were difficult for them to get into. And, it's part of the partnership. It goes beyond just the financial relationship. But, when the question came up, SPAC versus IPO, we were one of their first calls when they wanted to evaluate the direct listing versus the IPO. They wanted that third-party public market investor sounding board to help provide some perspective, at least in terms of how institutional public market investors would view those decisions as they go. And so we're pretty excited. We do expect an IPO from this company early next year, and we are excited to continue to partner with them for an extended period of time.
Terrific. Okay, well, that's very helpful. Appreciate both of your perspectives there. Most strategic asset allocations, certainly for institutional investors, typically have a clear division between the public market allocations and private market allocations. And of course, these strategies that we're speaking about, we're blurring the lines between public and private. So how should end investors really be thinking about where pre-IPO strategies fit into their asset allocation models, given some of the risk and return characteristics?
Yeah, I think you kind of addressed it in an interesting fashion. I think the crossover space is a space that continues to develop, and it spans between private and public, or two separate boxes that most allocators have with different investment teams focused on each box. And often many investment teams within each box focusing on different asset classes within those boxes. So if I don't have everybody confused yet.
I think I need to draw a Venn diagram first.
But really, the way to think about it, I'd say private equity investors are one category where this certainly fits as they think about a private investment, the liquidity profile when it's private, and ultimately the transition to the IPO. Public market investors also have interest in this, given how quickly the company goes from private to public in a crossover round. And then there's the opportunistic bucket that allocators have, which is structured and set up just for something that doesn't fit into a box at a particular allocator. But most private equity teams find the strategy to be really interesting simply because they're used to like a 10-year fund life at a typical private equity fund, or sometimes 15 years of venture capital, where in crossover equity, the fund life is anywhere from 5 to 7. So it's roughly half the time. And that creates the ability to get their capital back and or redeploy it. It provides much more flexibility, but it also provides a somewhat of a margin of safety given how quickly the companies ultimately do become liquid in the stage at which we're making those investments. Most venture capital funds are dominated by just a few investments. For most later stage crossover investments, most of those are ultimately going to go public, and the returns generated by those funds are made up of most of the investments the fund ultimately makes. So the risk is much more diversified and something that they often find to be quite unique and differentiated, both in terms of the duration of the fund, the lack of correlation to the rest of their portfolio, and the quick return of capital. On the public equity side, it's a little bit of a different value proposition. These investors are used to dealing with correlation to the S&P 500, trying to beat an index or a benchmark that is out there. They're always looking for uncorrelated streams of alpha, and that's really where this fits in. And then there's the opportunistic bucket, again, reserved for those strategies that might straddle the lines between two different boxes that a typical allocator. And oftentimes this is a fantastic fit for that box as well.
And if I might add just one thing, which is it's always important not to forget the actual individual investment risk reward with crossover investing. Part of the attractiveness that often gets overlooked is the potential opportunity to be involved in structured deals that can help create asymmetric risk-return profiles for our investors. So there is always options, potentially, to have enhanced deal structures that may include structurally advantaged preferred stock. It may include IPO participation rights. It could have liquidation preference or even consent rights. All of this can be structured in an extremely valuable manner for our underlying investors, which, again, could cross different universes depending on their broader asset allocation.
Yeah, I think that's an important nuance. Thanks, Mark, for that. As we start to wrap up here, it'd be great to get both of your final thoughts about what you think makes this space particularly exciting, or anything else that you'd want to share with someone trying to learn a little bit more about the pre-IPO space. So, Mark, maybe starting with you.
What gets me really excited is I think we live in a time where the speed of change is upon us. Everything happens faster nowadays. With ever-improving technology, greater transparency, and tremendous information flow, the trends we all see are emerging quicker and more powerful than ever. And so against that, you're having market share shifts that used to take a decade or two are being done in potentially months and years now. And that's, again, that understanding, this blurring of the lines that we've talked about on this episode is effectively you have to understand both the public and private markets when you're doing any form of investing. They cross over to one another. And to give specific examples, for instance, in the COVID environment that we all lived through, there were consumer internet companies that had business plans to reach total addressable markets in 4 years that did it in 4 months. And perhaps the most amazing and impressive was we had the development of vaccines that took months instead of years. It's truly an amazing time of innovation, and some of the late-stage private companies are clearly leading the charge, and that's the attractiveness of jumping into this space as it continues to grow.
Yes, I would completely agree. There are absolutely fascinating opportunities to partner with really dynamic companies that we expect to grow long into the future, both up into their IPO and well beyond their IPO. And the ability to be a partner to that company, especially when it reaches an age where that IPO and that next transition is really starting to form, and to be a partner in helping making that become a reality, I think puts us in a position to interact with some of the more exciting companies that are out there, some of the most fascinating growth trajectories that are out there. But it's unique to get a pure play in that space and to be able to have that type of access. And so I agree with Mark. I think that things continue to accelerate. Company formation continues to accelerate. And the ability for companies to do unique and novel things that help create or drive secular change is also set to accelerate.
Great. Thank you very much. And for a bonus question today, in my introduction, we talked a little bit about SpaceX for just a moment. So my question for you is just a simple yes, no, but love any additional color. Would you go on to one of the rockets to go up into space? Any hesitations that you might have, Mark?
Oh, I'm a quick, hard no on that one. I can't even do roller coasters. So that one, I'll take the pass and watch from the spectator seats.
Sounds fair. What about you, Gabe?
Yes. After a few years of testing just to validate, the success rates versus the failure rates, I'm fascinated and would absolutely love to explore space at some point in the not too distant future.
All right. Well, Mark and I will be holding the handbags, watching everyone. Thank you very much.
Perfect.
But look, thank you both so much for joining me today. From this conversation, I think what I have certainly learned is that pre-IPO investing in this time really is the epitome of disruption. So very on brand for this podcast. And, Mark, to some of your points here, everything is happening faster. Gabe, I think you mentioned that lots of people can provide capital, but to be a partner that can drive value, be that third-party sounding board to provide guidance, that's a source of real value add. Thank you very much for enlightening our listeners about this very interesting space and the blurring of the lines between public and private. This has been terrific. Thank you very much for joining me today.
It's been a pleasure.
Thank you.
And to our listeners, as always, if you enjoyed this episode of Disruptive Forces, I encourage you to subscribe via Apple Podcasts, Google Podcast, or Spotify, or you can visit our website, www.nb.com/disruptiveforces, for previous episodes as well as more information about our firm and offerings.
This podcast contains general market commentary, general investment education, and general information about Neuberger Berman. It is for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. This communication is not directed at any investor or category of investors, and should not be regarded as investment advice or a suggestion to engage in or refrain from any investment-related course of action. All information is current as of the date of recording, and is subject to change without notice. Any views or opinions expressed may not reflect those of the firm as a whole. This material may include estimates, outlooks, projections, and other forward-looking statements. Due to a variety of factors, actual events or market behavior may differ significantly from any views expressed. Please refer to the disclosures contained in the episode notes and episode details, which are an important part of this communication. Investing entails risks, including the possible loss of principal. Past performance is no guarantee of future results.